Hello and welcome to Markets at Noon. Let's just look at what's happening in the markets and really what's going around. So markets are back again to day's highest point, or almost day's highest point. One can say it's not that they're at the day's highest point, but it's broadly in line with what's happening in as far as yesterday's pullback which happened, or probably the markets are now digesting. Plus crude was down, so that's also something which markets are taking a note of. Let's just pull up the top gainers, top losers. I think that will give you a sense of really what's happening in the market, how things are moving around. So 1.2%, 1.6% actually now higher for the small cap index. So that itself is looking in pretty good. Bajaj, Hindustan, Union Bank, of course, these are some of the movers from the mid cap space that essentially are going on right now. That's Bank of Baroda, that's Canada Bank back to the levels of 271. You have a HPCL, BHEL, Biocon. No particular reason that I could associate for Biocon move, but nevertheless it's up 4%. It's fallen also quite a bit once the numbers had come. You have a Bandhan Bank which is now down 4%. You have a ONGC which is down 1%. You have a Tech Mahindra that's down another 1%. Remember, since the results day, Tech Mahindra is down about 40 or 50 odd rupees if I'm not wrong. HDFC Life is down 1%. HCL Tech is also looking weak. Gautam Duggad from Motilal Oswal is now with us. Gautam, what do you make of the mandate that has come out? What does it mean for markets? What sort of questions are investors asking you after this move?
Hi, good afternoon. The mandate obviously is very historic and unprecedented. We've never seen this kind of pro-incumbency expansion of vote share across states, across regions. So it's a very big mandate, perhaps bigger than 2014, and therefore it allows a lot of political capital to the Prime Minister to implement whatever changes, whatever reforms, whatever policy agenda he wants to implement. From a market's point of view, obviously it's a very big sigh of relief. If you remember 2 weeks back, a lot of people were discussing about potential of third front, hung parliament, fractured verdict, all sorts of things were getting speculated. So market will obviously have a sigh of relief, and from a next 5 years point of view, it's a very strong, stable government which will be at place. So that overhang is firmly behind us now. From an economy and markets perspective, obviously there are certain short-term headwinds. I would reckon rural consumption moderation and the credit market liquidity issues in the NBFC sector that we have seen for the last couple of quarters. Two big issues that needs immediate redressal from the government's standpoint, and also from a market standpoint, because after a week or so, once the government formation exercise is behind, the focus will revert to fundamentals, valuations, earnings, and corporate earnings cycle right now is not looking that great. The commentary for some of the sectors is not very encouraging. So earnings have been downgraded, though at a smaller, slightly lesser pace compared to the last 2 or 3 years. So from a valuation point of view also, we are at around 20 times. So one has to be very judicious in sector and stock selection, both in large cap and mid cap. But clearly this has revived the sentiment. Hopefully it leads to improvement in flows in the next couple of months/quarters, and then that would augur very well from a top-down perspective at least.
Gautam, there's definitely a lot of optimism on back of stability. Even when it comes to policy predictability, even that goes up now that we know that NDA is going to be continuing in the next term. Tell us, how is it likely to impact the FII, confidence in the Indian equity market? What is the flow trend likely to be?
Yes, obviously I concur with you. The stability is very important, because we have seen what happens when the government has a decisive mandate. We saw GST, we saw IBC, which led to whole change in credit culture. We saw RERA, even demonetization, and several other DBT related reforms. So from a flows point of view, FI flows point of view, it does provide a very sanguine backdrop for anybody who's looking to invest in emerging markets from a next 3 to 5 years point of view. This provides a very big catalyst for them. It will also augur well from a currency and a bond market viewpoint also, because we have been able to get our hold on inflation for the last 4 or 5 years, and with inflation hovering in that range, which is targeted range of around 4%. I think that the macro backdrop of India changes very positively, and at the same time we saw if crude comes to the rescue, if we see another $5-10 fall in crude oil prices, this will give a huge flip to our macro fundamentals. And at the same time, if we see the ongoing recovery in earnings led by financials were to continue, this will result in significant improvement in FII flows. You have seen that the last 5 years, the total institutional flows were dominated by the domestic, flows, and FII flows were very tepid. If you add up the last 5 years equity flows of FIIs, so possibly we can see a change in direction over there and also change in magnitude.
Right. Could you also just talk to us, because you look at consumption as a pack particularly, you have been looking at it for a while. What do you make of the commentary, the numbers, now that elections are behind? How do you expect any pickup or any signs of pickup? In which sectors would it start first?
I think the first and foremost agenda for the government ideally should be to revive the rural consumption engine, because consumption engine has been very strong for India for the last 8 or 10 years. Investment has been slow. We have seen some uptick this last 3-4 quarters in investment as a percentage of GDP, but for India, when it comes to the broad macros, consumption assumes a significant importance. So therefore, the commentary on that front from autos, from consumer staples and some of the discretionary companies has been a bit weak compared to the previous couple of quarters. So it is very important for government to get that equation right. Plus again, 3 months later we will head into another election cycle where 3 big states are going for elections. I think Maharashtra, possibly Haryana and Jharkhand is also lined up somewhere around that October-December part of the calendar year. So government will also want to prioritize how to revive the sentiments in rural markets, rural economy. Lot also hinges on how the monsoon shapes up. But I think in the short term there could be some softening that we have already seen, can continue for a quarter or two, but it allows investors to pick and choose stocks that they like, which they couldn't buy when valuations were very expensive, when the volume growth and other key parameters of the P&L are going through some softening. I think it will allow people to pick and choose stocks without getting too unnerved by the valuations, because stocks I don't think are going to run away from here as far as consumption space is concerned, because when your forward P's are already in the range of 40 to 50. So I don't see any significant room for re-rating in the short term. Having said that, from a 3-year point of view, there are a lot of interesting structural and secular stories which are available in the consumption space, both staples as well as discretionary.
What do you expect with cyclicals? Do you expect cyclicals also to do well now in this second regime? I have very stock specific views. I would think that financials are expected to do very well in this year, and then the new cycle begins. We have already seen some improvement in credit growth. Large part of the asset quality cleanup is done. Cases in IBC are now seeing logical end. There could be some write-backs for a lot of the corporate focused banks. At the same time, both SBI and private corporate banks, we have seen significant improvement in PCR ratios. So possibility of higher profitability and consequently a very strong recovery in the return ratios does exist for a lot of the private corporate banks. So cyclicals from financials point of view should do well, but from a point of view of commodities, I am not that sanguine there. We've been having a very cautious view on both metals and oil and gas for last 1 year, which we still persist with. So for us, when it comes to cyclicals, the first preference is with financials, followed by auto. But even in auto, to be very selective, we prefer 4-wheelers compared to 2-wheelers there.
Great chatting with you. Thank you so much for helping us out with your perspective on the outcome of elections.